Hello, everyone. Welcome to the stream. Albert Liu here alongside Rick Rule. Rick, how are you doing today?
Very well, Albert. Thank you.
To the folks coming in now expecting to see David Stockman, we apologize. David had to cancel at the last moment, so we are working on rescheduling him for a future stream. If you'd like to see him, please make sure you tune in, and also want to remind you that you can see him at the Rule Symposium this July in Boca Raton. We will post the link in the comments stream for you in case you are interested in attending. Rick, we don't have David with us, but perhaps we should turn this into a bit of a preview for what's coming, because what we were going to talk about is very timely, and it's occupying the news headlines, and obviously a lot of people are interested and that in the topic, and that is the budget, Rick. So what are your thoughts? Maybe introduce this topic for us.
Yeah, I think it's really important, Albert, and the attendees are going to have to bear with me because we're going to do a bit of math at the beginning of this session. I'm particularly interested in hearing what David Stockman has to say because of all the interest expressed in American politics and economics around the Department of Government Efficiency. For those attendees who don't know, David Stockman was the director of the Office of Management and Budget under Ronald Reagan in the first term of Reagan coming into office. David Stockman wrote a book called The Triumph of Politics, where he talked about how the Reagan Revolution, and remember that Reagan had a real mandate. He won by a large majority of the popular vote, as opposed to Mr. Trump's fairly narrow mandate. Reagan had a very, very broad mandate to reduce the size of government, but failed. And David Stockman's book, The Triumph of Politics, details how politics derailed the Reagan Revolution and thwarted the will of the American people. That is a very, very, very important book. I would almost regard it as required reading for an American taxpayer or an American voter. And I would urge any of you who intend to come either live or via live stream to the symposium to have read that book. Much more recently, David has written another book about how to cut $2 trillion out of the annual budget. It's grim reading indeed, but I think it needs to happen. And so I'm going to kick off today's discussion. And yes, we will leave time for Q&A about more mundane topics like individual companies. But I want to focus on the really, truly big picture for a little while. Note that this is of particular concern to Americans, but given that the United States is 23% of the world's private savings and investment market, this is of interest to savers and investors around the world. So, Albert, let's get right to it. I sort of talk about this line of questioning as, quote, the math of America. For those of you who have a writing instrument present, you might want to take down some of those notes. For those of you who are given to nightmares, you might not want to. Let's start with the Internal Revenue Service estimate of the aggregate private net worth of American citizens. This is the amount of money that, left to their own devices, the government could take from us if they decided that rather than taxes, they were going to steal all of our wealth. As at 2014, the IRS believed that the aggregate net worth of American citizens was $141 trillion. Now, we've had a decent equity market since then. So let's, for fun, say that the private net worth of Americans, understand this is not our interest in the Commonwealth, which is to say federal assets, the private net worth of American citizens, for purposes of this discussion, we'll fix at $150 trillion. $9 trillion escalation from the IRS's own estimates in the interest of generosity towards the Fed. Now, you've heard a lot of objection to the budget as being a giveaway to the billionaires and the suggestion that we should raise taxes on the billionaires to fund the gap. Here's the problem with that. The IRS estimate of the aggregate net worth of American billionaires is $6.7 trillion. $6.7 trillion. So let's round that up to $7 trillion, because the expectation of the extension of the Trump tax cuts has done a good thing to equities markets. So let's round up the billionaires' net worth from $6.7 trillion to $7 trillion. Now let's look at the income line on the balance sheet before we return to the rest of it. Gross federal revenues for 2024 were approximately $5 trillion. 4.97, but let's do $5 trillion to make it easy to figure. That's the money that the Fed took in from all sources: taxes, tariffs, fees, all that kind of stuff, rents. The problem, however, is that the aggregate federal government expenditures were $6.9 trillion, and that was an estimate subject to revision. Note that both the revenue number and the expenditure number are federal numbers only, before state and local governments. So when I talk about $5 trillion in revenues and $6.9 trillion in expenditures, I'm confining this discussion to the federal level. Back to the balance sheet from the income statement. The on-balance sheet liabilities of the federal government, which is to say money that is owed to bondholders, now exceeds $36 trillion. $36 trillion. And will, of course, go up by the extent of the on-balance sheet deficit, which is to say between $1.9 and $2 trillion a year. You can reduce that $36 trillion number by the Fed's own balance sheet, which is to say mostly holdings of Treasury securities and other government-issued securities of about $7 trillion. So if you take the $7 trillion in assets that the Fed has from the $36 trillion in federal liabilities, what you end up with is $29 trillion in net on-balance sheet obligations, before, of course, state and local obligations. And when people talk about the national debt, when people are concerned about the national debt, what is reported 999 times out of 1,000 is this number: the on-balance sheet liabilities of the federal government. Given the fact that the on-balance sheet liabilities of the federal government are substantially larger than the GDP, and are in fact themselves, 7 times the size of gross federal revenues before any spending? That's pretty scary, but nowhere near scary enough for our discussion. You see, the off-balance sheet liabilities of the US government, which is to say the net present value, today's discounted value of unfunded federal promises, military pensions, federal government pensions, the Pension Benefit Guarantee Board obligations, yes, Social Security, Medicare, Medicaid, the Environmental Trust Fund. This number, the net present value of unfunded federal promises, the off-balance sheet liabilities of the US government, exceed, according to the Congressional Budget Office of the United States, $100 trillion. This is not some cranky old libertarian named Rick Rule telling you this. This is the Congressional Budget Office, and my suspicion is that that number is a generous number from their point of view, which is to say, I think it's substantially understated. If you look at the US debt clock, or if you consult Shadow Stats, you will get a much higher number than that $100 trillion number. But I don't need a higher number to make my case. So let's use the government's own number. The net present value of unfunded government promises, not the nominal value, the net present value, today's number exceeds $100 trillion. If you add that $100 trillion to the $29 trillion in net on-balance sheet liabilities, you have an amount of money that the Fed owes or has promised of almost $130 trillion. But wait, it gets worse. Remember that $130 trillion is growing every year by $2 trillion in on-balance sheet deficits. And according to the Congressional Budget Office, $2.5 trillion in net present value of unfunded liabilities, which is to say that $129 trillion gets worse every year to the tune of $4.5 trillion. Now let's look back at an earlier number. The gross federal revenues before any expenditure on anything is $5 trillion. And the increase in on-balance sheet and off-balance sheet obligations every year is $4.5 trillion. This is an interesting set of circumstances. An interesting set of circumstances in particular because of the first number of all. The aggregate private net worth of American citizens is $150 trillion. If you take that $150 trillion, the aggregate private net worth of Americans, and you subtract our federal obligations of $129 trillion, there isn't much money left to work with, say $21 trillion. And the problem with that $21 trillion is it seems to be promised away at the rate of $4.5 trillion a year. Now, in one sense, this overestimates the problem because the aggregate net worth of Americans continues to grow. We've said before in the Rural Classroom that the amazing thing about the United States is that the tenacity, the brilliance, and the persistence of individual Americans is such that our individual creativity has for 200 years funded our collective stupidity. But I want to say that the arithmetic in front of us is very grim. When you hear pretenders say, oh, no problem with Social Security, all we need to do with Social Security is tax the billionaires and we fix the problem, there's two difficulties with that. The first of all is it's factually untrue. But the second problem is that you need to look at Medicare, Medicaid, Social Security, all of those together as a bundle. You can't suggest that you're going to use all of the resources of society to fix one problem and leave all of the other problems unfixed. When you talk about the Medicare problem or the Medicaid problem or the Social Security problem or the federal pension problem or the military pension problem, you have to look at them as a package. And the whole package has $100 trillion in net present value of unfunded promises. But it gets worse because the demographics are bad. When Social Security, as an example, was started, benefits began at age 65. And by the way, they were basically poverty level benefits. Now benefits for anybody begin at 62, but their definition of disability is such that millions of Americans enjoy Social Security benefits before they reach their 60s. At the same time that the population is aged, there are more beneficiaries, there are fewer contributors. So the demographics around entitlements are particularly bad. Remember once again that the net present value of entitlement liabilities grows by $2.5 trillion a year. What are we going to do about this as individuals, as a society? The truth is I have no earthly answer. As individuals, I think that we need to understand that for ourselves and our family, that the circumstance that we've been led to believe is true for the last 50 years will not be true going forward. I'm not trying to say that we're going to gut America. What I'm trying to say is that you need to make provisions for yourself and for your own family, because society will be unable to make provisions for you to the extent that they have promised. What will we do politically about the problem? Well, I have some ideas. I don't think any of them are good ideas. I wouldn't suggest any of them, but I think they're going to happen. The first thing that's very likely to happen is that they'll fiddle around the edges with entitlements. They will, as an example, take away the cap on income for Social Security, which is to say that the exclusion of income over $160,000, which currently exists, will go away. So high income taxpayers, like the ones listening to this podcast, can look forward to paying lots more in Social Security taxes. And after they do that, I'm pretty sure that they're going to means test many of the benefits, which is to say, despite the fact that you pay more, you're going to get less. Entitlements are going to become looked at much less as an insurance function and much more as a transfer function. That's going to happen, I think. And I think lots of eligibility requirements will be tightened up, particularly tightened up in regards to those people who have paid in the most by way of tax, which is to say the people who have been taxed the most are going to be the people who benefit the least going forward. That's going to happen. The nature of a democracy is that there are more spenders than savers, and the spenders always vote when they have the option to penalize the savers. Look forward to more of that in the future. But that is nowhere near enough to solve the government's problem or the problem of the intended beneficiaries. Remember that this problem is $100 trillion problem. That's a really big problem. So what does Rick Rule think this looks like over the next 20 years? Well, in this regard, I think that the decade of the 70s is one that we need to look at. I think that you solve this political problem by honoring the nominal value of the obligations, which is to say some old codger named Rick Rule, who's supposed to get $4,000 a month or whatever he's supposed to get in Social Security, will continue to do it. But they will reduce the spending power of that $4,000 a month substantially. Did you know that according to the Office of Management and Budget, David Stockman's old agency, that the spending power of the US dollar in the period 1970 to 1980 declined by more than 75%, which is to say what $1,000 bought you in terms of goods and services in 1970, or put differently, what $250 bought you in 1970 is what $1,000 bought you in 1980. I think that the political solution is to inflate away the net present value of the obligation while honoring the nominal value of the obligation. In other words, devaluing or reducing the purchasing power of the denominator, the US dollar, is what allows us to keep the numerator intact. Albert, that's it for my rant, but I hope everybody has taken this into context so that they can listen very, very, very carefully. First of all, when we finally get around to having David Stockman be interviewed, and then, of course, at the Natural Resources Investment Symposium, whether or not you attend live or via live stream. Thank you for suffering through that, Albert, and ladies and gentlemen.
Thank you, Rick. And that link is in the comments if you want to check out David Stockman's talk at the Rule Symposium. It's always a good time. We always throw in a panel or two in there as well, where Dave, Rick, and our other headline speakers grapple with the big questions facing us. Rick, that you set up that very nicely. And you know, when you hear numbers like 80 trillion and 100 trillion, I mean, it really, you know, you don't really have to go to the fine details of the accounting to realize that this problem is insurmountable, most likely. And it's, you know, my opinion is there's going to be a default, and the default will just take different forms. Some of the forms you outlined in your introduction, Rick.
Well, I think that's right. I think a default is inevitable. There's two different ways we could default. We could be honest about it. We could say to the bondholder, too bad, so sad, no money, strong letter to follow. And we could say to the entitlement beneficiary, well, we know we promised it to you. We know you paid into it. We know what's fair is fair, but that doesn't matter. There's no money. You can't have it. I don't think that's what we do. That's not part of the American political culture. It's not part of any society's political culture. I think that we have a dishonest default. We have a creeping default. We have a default where we honor the nominal value of the obligation while devaluing the purchasing power. I'm smiling, not because I want to see people suffer, but simply because of the irony. I remember H.L. Mencken, to paraphrase H.L. Mencken, the voters almost always get what they want, often good and hard. And I think an outgrowth of 70 years of making collective promises to us, to each other, means that that's what's going to happen. When I make these comments, Albert, on social media, which I do fairly frequently, as you're aware, I get a lot of hate from old codgers like myself saying, Rick, I've paid into Social Security for 70 years. This isn't fair. Where's my money? Well, your money's been spent. It's been spent on stuff you voted for. The truth is that the Social Security Trust Fund was invested in very low yielding 30-year U.S. Treasuries, and those U.S. Treasuries funded current account deficits going all the way back to the time of FDR. The Great Society was built on your retirement. The money has already been spent. It's gone. And what people need to understand is that they have to take care of their own future. They need to plan now. They need to save now. They need to invest now. They need to get their families and their friends' heads wrapped around the fact that these are mere promises. Also, Albert, when people attack these numbers of mine, they say, well, you weren't taking into account the assets of the Commonwealth. You're not taking into account all the gold that the U.S. government owns, all the real estate that the U.S. government owns. To that, I say, good luck trying to collect. If you are talking about using the common assets to secure the debt, that assumes that the creditor can collect on them. And I have no particular interest myself, Albert, although I am a lender, of going up to Mr. Trump or before him, Mr. Biden, and saying, listen, I have this bond. You're in arrears, and I'd like to collect your gold, please. Remember that the government has a monopoly on violence and extortion. So the idea, as an example, that you could inflate the asset side of the Fed's balance sheet by repricing all the gold suggests that the people who are owed the money have access to the gold, which they do not. It's a promise to pay.
Rick, Adrian and I had a live stream yesterday on the Rule Plus network, and I made that exact point. These Federal Reserve notes are not credit money. They're fiat money. They're no longer warehouse receipts. Doesn't matter what value you put on that gold. That does not entitle you to redeem your notes for the gold. So all that can come of that is they'll either spend it or they'll borrow against it. And it doesn't solve our problems.
And by the way, Albert, you and I and your kids are going to get through this. We're going to find a way. We found a way through the decade of the 70s. But we're not going to find a way by trusting our elected leaders. We're not going to find a way by believing that the Commonwealth is going to take care of us. So anyway, enough of our rants.
Okay. I just want to put a little plug in, though, for Jayant Bhandari's conference, because if you like these discussions, these are the types of discussions we have every year in Vancouver with Jayant. Rick, I don't know if you have a topic yet, but I always look forward to your talks. And we have a lot of other great people speaking at that conference. And I will be sharing my own feelings on the future of the United States at that conference. So link is in the chat. Jayant's a great guy. He's a friend of the classroom. He's done several live spots for us already. And actually, we have another one coming up very soon with Jayant Bhandari. So if you're interested in macroeconomics, society, culture, politics, from a free market point of view, this is the conference for you, Capitalism and Morality 2025. Okay, Rick, shall we get to some of these questions? People are always interested in hearing your thoughts on specific companies within our sector. Sage China's asking about Seabridge and Mondoro.
Very different companies. Seabridge is the classic optionality company. Seabridge controls, among other things, a very, very large undeveloped gold deposit in northern British Columbia, the Curragh Sulphurets deposit. This deposit, post the acquisition of Snowfields, which they completed a few years ago, contains well in excess of 100 million ounces of gold and an awful lot of copper, too. There are at least two problems with it. The first is that this gold is extraordinarily low grade. And the second is that the deposit's very, very, very remote. So one wonders, even at $3,000 gold, if this is a developable deposit, given that it would cost between $8 and $10 billion to develop it. If you believe that gold prices are going higher, this is maybe the ultimate optionality play, in that the higher gold price disproportionately favors deposits where the economics are currently marginal. And spreading this benefit over 140 or 150 million ounces is obviously an intriguing proposition. I've known Rudy Frank for a very, very, very long time. I, in fact, competed with him to buy Kerr sulfurettes. He outbid me, which is why his company is worth $1 billion today and mine is not. Mandoro is a very different kettle of fish. A very, very, very bright young woman, at least young compared to me. They all are. Who is a prospect generator looking for copper gold porphyries, particularly in the western part of the Tethyan metallogenic belt, but also in Arizona. Mandoro is unusual in that their overhead is so low that despite the fact that they aren't in production, they generate a net profit after tax as a consequence of the fees that they charge major mining companies to explore their terrain. An extraordinarily attractive but high risk speculation in copper gold exploration run by an extraordinarily competent woman.
Okay. Rick, I'm getting a bit of an echo. Did something change on your end? Hang on, I'm just going to mute you for a second while I get this question out.
Okay.
What's your opinion of the Equinox merger?
I think the Equinox merger is in the interest of all shareholders. For those people who don't know, Equinox is acquiring another acquirer, in this case called Calibre. Calibre recently acquired a to-be-built asset in Canada. This will play on Equinox obvious mine building skills, but the acquisition will take Equinox up to about 950,000 ounces a year production, very close to Ross Beaty's stated goal of 1 million ounces. My suspicion will be after the acquisition takes place that the Equinox team will sell 2 or 3 of the more marginal assets. That goes back to Ross's game plan over the last 40 years. Get a starter kit to build a company, use that starter pit to tell a story, develop a community, lower your cost of capital with the community, buy some better assets, sell the worst performing assets, build a very, very large company over time. Remember that these large companies enjoy more trading liquidity, which means they have a lower cost of capital. In a capital-intensive business, that's an advantage. But they have at least 2 other advantages too. The first is that prudently run large companies have lower general and administrative expense relative to either assets under management or cash flow. A different thing they have is more opportunity to allocate capital efficiently over a portfolio. A single asset company has one place to invest money, win, lose, or draw. A company like Equinox has 10 or 11 places to allocate capital, and they can choose among those which one has the highest return on capital employed. In the immediate aftermath of a merger like this, it's very likely that the stock sells off. There will be people who owned Calibre because they thought it would be taken over, and they always intended to sell. There will be other people who owned Calibre who, given the fact that Calibre received no takeover premium, will be disappointed and sell. So one could expect in the immediate aftermath of the merger that the share prices fall. That is almost always an opportunity in circumstances like this, because the virtues associated with the merger, larger company, greater trading liquidity, more efficient management expenditure relative to either assets under management or free cash flow, are very, very, very apparent. This company will be almost a 1 million ounce producer. It will have a $5 billion market cap. There will be increased index buying because of the increased size and trading liquidity in the company. A good deal for all concerned.
Wonderful. Rick, from Evan, can you comment on the ranking of Osisko Development Corp? Tough environment for it lately. Curious if you have any thoughts.
I have Osisko Development as a 6. The virtue that they see in some of their development opportunities is lost on me. Although I will say that almost every time I've bet against Sean Roos in my career, I've been wrong and he's been right. That notwithstanding, I have them at a 6 currently.
Okay. Pertaining to the opening discussion, Rick, George asks, do we have any thoughts on how the current administration is handling things via the Doge committee?
Well, I don't know exactly where the question goes. I looked at the budget that was approved yesterday, and it's pretty obvious that, with the exception of Massey, there's no particular Republican in Congress that has any interest in reducing government expenditures. The Republicans seem to believe the deficits are a tremendous problem when the Democrats run them up, but they have a lot more tolerance for their own deficits. I've seen lots of smoke and fury around Doge. I've seen lots of stuff that's allegedly been cut. I've seen people fired, but I haven't seen it show up in the numbers yet. If the questioner would read Stockman's book, The Triumph of Politics, unfortunately, the questioner will get a pretty good sense of where I think this is headed. Which is a place that's not good.
Yeah, I think it's so far turning out to be what you'd expect, and that is it's branding. It's just
exactly.
new branding on the same old policies.
And I can say a lot of good things about Mr. Musk, but Mr. Musk is an extremely headstrong guy. He wants, among other things, to go to Mars, and I think he wants to do it with my money.
He's done everything else with your money, Rick.
The idea that somebody running the Department of Government Efficiency made his name by getting subsidies for Tesla and getting subsidies for SpaceX makes me, on the face of it, a little leery about his zealotry with regards to real government efficiency.
Yeah, and the other guy ran for the exits. And talking about Vivek, the other guy ran for the exits maybe after reading Stockman's book. He's long gone. Let's see. Okay, Brendan asked, please address U.S. gold reserves. When was the last paper audit? Sounds like a question for Ron Paul. Rick, do you have any views on that?
Well, my understanding is it hasn't been audited in a way that was made public for 40 years. I'm not trying to say the gold isn't there, but I do think it's our gold. I think we have a right to know. And I'd like to see that dispelled. And by the way, the idea that Mr. Trump is going to go there, maybe with a video crew, and come back and say, I've seen the gold. It's huge. It's there. I love it. It's wonderful. That doesn't work. It's not an audit. There's great audit procedures in place. Sprott audits, 10 or $12 billion worth of precious metals a year, every year. There's lots of great audit procedures in place. We don't need to reinvent this, but we do need to do it.
Yeah. Yeah. And I'd like all these vaults to be audited concurrently, Rick.
Sure. And with regard to the Sprott gold, in effect, they issue a title opinion on it. It's one thing if it's there, but hypothecated, which is to say they're storing it, but they don't own it. I don't believe that's true, but I don't want to have to believe. The whole point of gold is that you have an asset that isn't simultaneously somebody else's liability. That's why you have it. So let me know how much gold we have, and let me know that it's actually an unencumbered asset, not somebody else's liability. This isn't hard.
Yeah. I mean, you do something like that before you buy a house. Why wouldn't you do that with the nation's gold?
If you look at all the other studies we carry out, one thing that Musk has done a very good job of is pointing out the various places that USAID money went to. I mean, we've done all kinds of weird studies. I'd like to see a little study called an audit of our physical precious metals. I'd like to know it's there. I'd like to know where it is, and I'd like to know who owns it.
Yeah. Yeah. More interesting to me, Rick, was all the places that USAID money goes that he didn't mention. Michael asks, any thoughts on Mr. Friedland's G-Pulse bringing hydrothermal energy to fruition?
No, I'd rather pass on that. As you know, Albert, technology is not really my long suit, so I'll pass on the question.
Yeah. From Tristan, thoughts on Hot Chili's recent La Verde drill results?
Clearly, they have a big porphyry cluster. That deposit's very large. It's extraordinarily well located, close to tidewater. Power runs across it. The Pan American Highway runs across it. It's next to a town that's got a whole bunch of mine workers in it. Everything's great except the grade. The only thing that stands between Hot Chili and really knocking the ball out of the park in this copper market is they need a high-grade starter pit. And thus far, they haven't found a high-grade starter pit. I remain of the opinion that somewhere within that porphyry complex, somewhere within that sea of copper, the copper fluids came into some portion of Earth that's been altered enough that greater concentrations of copper could have precipitated out of those fluids. I have no doubt that it's there. The question is, will they find it? And when will they find it? A second question, of course, revolves around water. They've done a good job getting a maritime concession from the Chilean government, but I want to see at least a preliminary economic assessment of what it will cost to develop that water resource and how much money per acre foot it will cost them to develop the processed water necessary to mine copper in the driest place on Earth, the Atacama Desert.
Next question, Rick, do you have any thoughts on Chamaran Petroleum?
I'm attracted to Chamaran. I own Chamaran. It's not for the faint of heart. Chamaran, for those people who don't know, is in the northern fold belt in Kurdistan, in Iraq. Occasional security difficulties producing the oil, lots of political difficulties within Iraq. No guarantee that Iraq stays stable. There is no doubt that the geology is insanely good. For those of you who don't know, this is a Lundin company. The Lundins have been pursuing oil and gas opportunities in Iraq for almost 2 decades. They don't do anything in a small way, but this is not one for the faint of heart with regards to political risk.
Okay, from Antia, do you think that in the case of a liquidity squeeze, it might be a problem to sell U.S. Treasury ETFs?
I think that's highly unlikely. Let's just say that almost every other debt asset class would be affected first. For my own reasons, I keep my maturities, my U.S. Treasury maturities, very, very short. I do that mostly because if we have a rise in interest rates, irrespective of liquidity, I'll suffer a capital loss on my longer dated treasuries. And I try to keep the risk on my liquid assets as small as I can. Note too that forwardation in the treasury market, which is to say that the premium you get for long dated assets relative to short dated assets, is so stingy, it makes no sense to take the duration risk. Having said that, I think that a U.S. Treasury ETF, particularly a short-term Treasury ETF, is a reasonable way to store liquidity. Probably not as good as buying the short-term Treasuries in your own name and rolling them over, but that requires aggravation, and I can understand perfectly if somebody would rather let somebody else do that for 11 or 12 basis points.
Yeah, I was just going to mention that Treasury Direct makes it possible. It's not difficult, but with these short-term maturities, it would become pretty tedious. Patrick asks, would like to know what Rick thinks of agency/company supply-demand projections. IAEA, EIA/NEA, Red Books for uranium, and BHP's copper report. What do you think of these, Rick?
I don't know enough about the nature of the question to answer it.
Okay. I would like to know what supply, I guess, the reliability of these sources in making projections.
Oh, you can't take any source in isolation. We have some pretty good analysts here at the Rural Classroom. And I think it's useful to take all the analysis in place. As an example, the KEPCO analysis, the Cameco analysis, certainly the BHP analysis. What seems to happen in the uranium business is that because the business is fairly opaque, particularly the term market is fairly opaque, that people put too much emphasis on individual reports and don't spend enough time getting their hands around the whole. There's a great discussion taking place in the Rural Classroom right now. I think the poster's name is The Asymmetric Investor, around the impact of the KEPCO announcements and the impact of the slowdown in the deployment of redeployment of Japanese reactors, and hence the continued overhang of Japanese fuel in the uranium market. And I'm not dancing around the question. I'm just suggesting that the uranium market is a fairly complex and very, very, very opaque topic. And one needs to take individual sources not in isolation, but rather as part of a greater whole.
Okay, great answer. From Michael, asking a question about Equinox debt, Rick. Is Rick confident that the management will handle their debt wisely?
Yeah, I think one of the reasons why the Calibre acquisition was attractive to them is that Calibre has a couple $100 million in cash and about $40 million in debt. So there's a $160 million net swing. Meanwhile, Calibre is making pretty good production at an all-in sustaining cost of about $1,600. So they're making pretty good margin. Equinox has somewhere around $1 billion in debt. But with Hard Rock now producing and the cash and cash flow from Calibre, what you're talking about is the ability to retire that debt in toto in a little over 2 years. So the debt circumstance now is entirely manageable at this gold price and these interest rates.
Okay. From Conrad, Rick, have you had a look at Liberty's mine plan? What do you think about it?
I have looked at it, and I think some of the assumptions are fairly aggressive going into it. So what I'm trying to do is get that mine plan digested by people who are more current than I with capital and operating costs in the basin and range. I'm not convinced.
Question from Gene regarding Meteoric Resources. Rick, stock keeps on dropping. Interested in knowing about the ranking. Is it an upgrade to a 3 yet?
It is not an upgrade to a 3, but I'm certainly looking at upgrading it to a 3. As the questioner points out, this is a very, very, very large deposit. It's a deposit that is likely only marginally economic at today's rare earth prices. I don't think today's rare earth prices change. It's a deposit that increases in size and hopefully increases in grade. As we come to know more about the deposit itself and the processing, this is one of the few stocks out there that I see that has legitimate 10-bagger potential. There's lots and lots and lots of risk, but this is the quintessential Rick Rule stock. This is a world-class deposit, absolutely out of favor. You understand exactly what the warts are. The deposit only gets big and likely it only gets higher grade. As you de-risk this deposit, particularly if, as I believe is certain, the market changes, this is one that could, although there are no guarantees, be a 10-bagger. I love 10-baggers.
Yeah, I'll point out many of these companies will be present at the Rule Symposium. So I look forward to seeing me.
Yeah, I should also disclose what I own when I answer these questions. Equinox, I own it. Okay. Shamaran, I own it. This one, Meteoric, I own it. Disclosure, long. In the case of Meteoric, way long.
Mm-hmm, mm-hmm. Rick, let's see. Your thoughts on Arizona Metals?
I don't own it. Nice deposit. It doesn't seem to me to be big enough to matter in my own portfolio. People like the fact that it's in Arizona. I counter with the fact that the Resolution deposits in Arizona is now 27 years in permitting. I can understand people who want a fairly simple deposit that's fairly well located in a state where at least the warts are understandable. I'm not discouraging owning it, but I don't own it.
Okay, from Lakshmi. Rick, please share your thoughts on Mr. Eric Sprott's recommendation of Jaguar Mining, which has been down for a while.
I mean, first of all, Eric's a billionaire and I'm not. So let's get that out of the way. Eric is a billionaire because he's got big. Yeah. And Eric believes in optionality. Eric and I worked together for a very long time. And when I was looking at a company and trying to figure out what my downside was, Eric was looking at a company and trying to figure out what his upside was. We have very, very different points of view, particularly where gold and silver is the discussion. Because when Eric looks at what could be, he looks at $5,000 gold. And when I look at what could be, I look at $2,000 gold. Looked at through that prism, Jaguar's very, very appealing. It's a deposit that could be fairly large, but it's a deposit that's been a real widowmaker in terms of being solvent. If the gold price goes up the way that Eric thinks it will, these marginal deposits that don't have to be permitted because they're also already producing make a boatload of money, and they make shareholders a boatload of money. When you juxtapose the risk to the reward, in other words, when you look at the way that the things that Rick Rule looks at stocks, you can't own it.
Yeah, it's the venture capitalists and the credit analyst meeting.
Yeah,
that's funny. Meeting kind of in the middle on some of these investments, I think, right?
Well, the few times like Kirkland Lake that Eric and I agreed on something, probably what I should have done my whole time working with Eric is nothing, unless he and I agreed on one stock, and then buy out them. Hindsight's 2020. There were only, by the way, 7 or 8 of those. So
sure is. So Alan is asking about the SG&A at Aclara Resources, Rick. We're taught to watch that closely. Yep. Management compensation and other deals, and how much of the budget is actually going into ground, so on and so forth.
Yep.
Your thoughts in general on Aclara?
I like the Aclara deposit. To be honest with you, I haven't looked at the balance sheet or the income statement for at least 3 months, so I'd prefer.
Yeah, that's fine.
That supposition.
Yeah. I mean, this obviously we don't like calling out people or companies, but there's been times when you've said, "Look, I like this company. Comp's a little bit high, but I still like it."
I remember once listening to a presentation by Andrew Milligan when he was going down a checklist of all the things he wanted to see before he bought a company, and Seymour Schulich was in the audience. And Seymour raised his hand and said, "That's a great checklist, Andrew. I'd like a nasty weekend with the Victoria's Secrets models, too. But you can't get everything you want." And so sometimes you take the good with the bad. As an example, I own NextGen. I think it's the best or the second best undeveloped uranium deposit in the world. G&A is insane. They're sponsoring the Vancouver Canucks hockey team. They're sponsoring Formula One racing. They're spending money on G&A and a whole bunch of stuff that has nothing to do with developing a uranium deposit or, frankly, lowering their cost of capital. It pisses me off, but I own the stock.
Right. When a company checks the boxes that you're looking for, and you go to the SG&A, Rick, what is the first thing you look at after you look at the bottom line? What's the first thing that you look at?
Is there a feasible reason why this G&A is in my interest? The work, as an example, that NextGen is doing to reduce the risk, the work that they're doing with Indigenous communities in Saskatchewan, the work that they're doing with floral and faunal surveys, all the advanced engineering work that they're doing, and they're spending millions of dollars a quarter on this. That's all good. There are parts of G&A that I feel absolutely happy expensing when they ought to be capitalized because they're adding value to me. But you have a lot of circumstances where that isn't the case too. And you have to look beyond G&A. One of the things that I look at now is severance expense. If a company is taken over, what percent of the takeover proceeds is likely to go to officers and directors by way of change in control fees and stuff like that? There is a small public company that I'm aware of where, in the event of a change of control a year ago, the stock's gone up now, more than the market cap would have gone to the officers and directors in salary and bonus and change of control fees. So it isn't just the current G&A, it's the obligations that the shareholders have made to the management team in terms of future G&A, which you have to use to subtract from net present value in doing securities analysis.
Rick, question from Tristan. Do you have any thoughts on Greatland Gold?
I own Greatland. I think it's a fantastic deposit, or really district. So yes, I own Greatland.
Okay. Clement says, what are your thoughts on Coeur mining?
I don't own Coeur. In the near term, they're going to generate a lot of cash from the Silvercrest asset, but the Silvercrest asset, at least with its current state of exploration, is a fairly short reserve life. And what you're going to need to see within Coeur is really good recycle ratio, which means they're going to have to use the cash flow from the Silvercrest asset to replace it. Coeur's 40-year track record in terms of recycle ratio, that is the ability to use free cash flow to replace and add to reserves, is not good. So unless there's a cultural change within Coeur in terms of utilizing the free cash flow from Silvercrest to grow the company, the outlook is not rosy.
Yeah, okay, so if you break that down, Rick, what do you look for? How can you analyze or begin to analyze a company's ability to do that outside of the track record? Obviously, that tells you a lot, but what specific things do you look for in management?
First of all, the track record is only relevant if the people who did the job are still there.
Yeah.
I assign Agnico Eagle a premium based on the fact that for 25 years during the Sean Boyd regime, that they had really good recycle ratio, either through acquisition or through exploration, construction, and development. They generated more new ounces than they produced in terms of old ounces. There was a culture there. And Sean Boyd is still there as chairman. He's no longer CEO, but more importantly, the team that did it is there. Recycle ratio is really a phrase that came from the oil and gas business. Our mutual friend, Jeff Howard, was an absolute master at looking back and constructing recycle ratios in the oil and gas business. How many barrels of reserves and resources were added from the margin for producing one barrel? Any number over 1.45 to 1 was good. 1.45 to 1 in the gold business isn't good. It's spectacular. But still, you're able to do it. It requires some work, but you have to go back and reconstruct the increase in stated reserves and resources. And you need to determine, either by way of acquisition or by way of expenditure, how much margin was required to get that done. In other words, is the business cannibalizing or is the business self-sufficient? And with regard to the big domestic silver companies, which is to say the sort of Coeurs or the Heclas of the world, this has not been the case for 40 years. It's very, very problematic. Now, what both companies have been pretty good at is taking advantage of strong silver markets and raising equity capital at advantageous times, and being willing to pay up for assets that would sustain their survival in the future. Survival is of questionable benefit to shareholders. So you need to have the ability to discern efficient capital allocation.
Yeah, that's a tough one, right? That's
It is
tough.
a tough
That's like your return on R&D.
Yep.
Tough. Okay, another question from Antia. This regards Franco-Nevada, Rick. They have contracted 2 streams in high-risk countries. Could this diminish the quality of the company?
No. I say no. What's a high-risk country?
Ecuador, South Africa, in this case.
But I would suggest to you that Canada's a high-risk country. I remember being an investor in the Canadian oil and gas business when the gas price went up, and the Harper government, a conservative government, and the government of the province of Alberta tripled the royalty on natural gas, which is to say, in effect, they nationalized a whole bunch of revenue that otherwise would have been mine. I remember, too, being part of Viceroy's discovery of the Castle Mountain deposit in the People's Republic of California. And that discovery took 13 years to put in production. Think what 13 years does to the net present value of the deposit. So when one describes Ecuador as a problematic country, it is. When one describes South Africa as a problematic country, it is too, as is the United States, and as is Canada, as is Chile, and as is Australia. The truth is that mining is a business that's particularly subjected to political risk. Albert, when you were a technologist, if you and your cohorts would have developed a very good technology and found that your host country was hostile, you could, had you wanted to, taken your brain and moved to Singapore or move to some more favorable location. By contrast, had you discovered a mine, you could move your brain if you wanted to, but your wealth was stuck. And that's the nature of the mining business.
It is the nature of it. Okay, so let's do a little rapid fire here. Only a couple minutes left, Rick. I'm going to get your thoughts on 3 companies. Just quickly, Dakota Gold, Vizsla Copper, and Anglo Gold Ashanti. Any thoughts?
Well, Dakota Gold, the recent preliminary economic work on the surface oxides was stunning. I mean, truly spectacular. Our interview here at the Rural Classroom of Bob Quatermain was a great interview. And by the way, very, very, very timely, I think. Sorry, remind me the other 2. I was touting my
Vizsla Copper.
Vizsla Copper. Vizsla I don't own. I like the people behind Vizsla a lot. I like their success in the silver business, but I haven't seen the data coming off the copper deposit that would cause me to get long.
Okay. And Anglo Gold Ashanti?
Anglo Gold Ashanti, I mean, the recent financial statement knocked the ball out of the park. It says a lot about the leverage inherent in the gold sector. I think either Anglo Gold Ashanti goes up in price or it gets taken over. Those are both happy outcomes.
Okay. And with that, we are out of time. So I want to thank you, Rick. I want to thank all of our members and those of you, if you're joining us today on YouTube or X, please, we'd like to have you join the community at ruralclassroom.com. It's free to join. We have over 10,000 very, very intelligent, insightful investors in there analyzing and commenting on their own investments. So we invite you to join the group at ruralclassroom.com. Rick, any parting thoughts for the audience?
A couple things. By all means, come to the classroom. There's lots of interviews. There's lots of how-to stuff. Use all that stuff that we did at the beginning of the Rural Classroom, how to analyze companies, all that kind of stuff. It's all there. It's all free. Free is a very attractive price. Pay attention, too, to the first part of this discussion, the math of America. This is your future. There's no way around it. It's scary. It's complex, but forewarned is forearmed. Pay real attention to the upcoming David Stockman interview. This is more important than anything that you're going to get out of Fox or CNBC. This is more important. The hour that we'll spend with David Stockman is more important than any 10 hours that you can get out of mainstream media. Use that to prepare yourself to come to the Natural Resources Investment Symposium in Boca Raton. I'd love to see you there in person. It's much better in person. But if you can't come live stream, remember, all the financial risk is mine. If you attend the conference, either via live stream or live, and you're not 100% satisfied with the results, just like our boot camps, absolute gold-plated money-back guarantee. The interview at the symposium with David Stockman will be worth the price of admission. You get the best natural resource investment conference in the world for free after that.
Yeah, and then you could get to interact with all the companies that will be there too, which is much more difficult to do online. So it's too much fun to miss. So please think about joining us. Rick, I don't know if David Stockman is even allowed on Fox News anymore. They used to have him on, but the way he's talking now, I don't know. I don't even know if he's allowed on TV.
I wish he'd be frozen off of there so he'd have to come on here weekly.
That'd be great. Okay, so yeah, keep watching for the David Stockman interview. And Rick, thank you very much. Can't wait to do it again with you soon.
Albert, thank you. And I apologize for being scarce this week or these last few weeks. As you know, my wife has had double knee replacement surgery, and I've been a home nurse, which is not my long suit. So thank you for your forbearance with me being away.
No, I understand. We understand. People have missed you, though, but you are busy doing what you need to do. So
First things first.
Much understanding. Yeah. So thanks very much, everyone. We'll see you again soon.
Thank you.